Good afternoon and welcome everyone to our annual financial reporting update, which aims to equip you with the latest information and insights you need to prepare financial statements for FY25. We are delighted that you're able to join us today. My name is David Francis and I'm Chair of the Bentleys National Audit Committee and also an audit partner in the Adelaide office. I will be hosting the webinar and moderating the questions. The QR code on the welcome slide will take you to our website where you can access more information about the seminar and also about financial reporting articles and resources. This is also where we will publish today's presentation recording and slides. We will send you an email with these details when it's published. Our presenter today is Carmen Ridley, Principal and Director of Australian Financial Reporting Solutions. Carmen is a consultant to the Bentleys Network and prepares our 6-monthly audit newsletters, provides regular training to our audit teams and works with many of our clients on technical, accounting and financial reporting advice. For our guests today who are new to Bentleys, Bentleys is a network of advisory and accounting firms with offices across Australia and New Zealand. We offer core services such as audit, tax and accounting, as well as an expanding range of specialisations to support the needs of modern businesses, such as emerging issues like ESG and carbon accounting, R&D incentives and business assurance, as well as things like wealth management, superannuation and super fund advisory. A few housekeeping comments about the webinar. We are using Microsoft Webinar technology, and this gives you the opportunity to ask questions. If you'd like to ask a question to Carmen or offer feedback or comments, please enter the details into the Q&A box and we'll pose these questions as appropriate during the presentation or during the Q&A session at the end. This session will be recorded and we will distribute the recording along with slides after the presentation. I hope you enjoyed today's presentation. Please keep the questions flowing and over to you, Carmen.
Excellent. Thank you, David, and welcome everybody. So I feel like I start these sessions each year with saying we haven't got a lot of new changes happening, yet I'm going to talk to you for the next 2 hours about things that you need to be aware of. So it's a similar thing that we've got this year. There's no major new standards. There's maybe one that's got a little bit of effort for you, but we have a lot of other things that are going on. So just in order to keep you updated, please, as we say, ask questions as we go. It makes the session much more interesting for you and for me, and we're very much monitoring that Q&A box. So I will pause at various points to ask David if there are any questions that have come through. Just the normal disclaimer that whilst we are very much encouraging questions, obviously this is for training purposes, and I may well caveat some of my answers with I haven't read your agreements, but based on what you're telling me, this is the best that I can offer you. All right, so the plan for the session is we are going to start with the accounting standards. Then we're going to give a little bit of a regulatory update, and then I'm going to talk about expanding that theme a little bit more about some contemporary issues that we are seeing, and that will cover across Australia. Sustainability or climate-related reporting, which really is the topic of the minute. So I'm just going to update you on where we are in that, a few common queries, and then I'm going to finish off with a what's coming, which is predominantly in the not-for-profit space that I want to talk about specifically in that. So hopefully in this session, we've got enough for you, regardless of whether you are private sector, public sector, for-profit or not-for-profit. There's something for everybody in here. So let's start with our accounting standards. So the new standards that are in play for 30 June 2025, we've really only got 4 that we have to consider. And of these 4, I'm actually only going to talk in detail about 2 of them. That's the first one and the last one. So I'm going to cover on this slide the other ones very briefly. The second bullet point on the slide relates to lease liabilities arising in a sale and lease back. Now, the standard itself, the amending standard, is really minor. All it does is make sure that both parties in the agreement have mirror accounting. It's a very simple, very narrow scope amendment. My bigger issue, however, with sale and lease backs that it gives me the opportunity to talk to you about is when we adopted the leasing standard, I kind of thought we would see less sale and lease backs because one of the reasons we used to see so many of them was to get things off balance sheet. Obviously, with the new leasing standard, if we've got a lease, we bring the lease liability onto balance sheet. So therefore, it doesn't actually remove it. However, in the current economic climate over probably the last 12 to 18 months, we have started to see more of these sale and leasebacks that are happening. And I think it's because when you do a sale and leaseback, you obviously get a huge inflow of cash, and entities still are finding that cash useful. The problem, and why I'm talking about it now, is under accounting, in order to have a sale, we need to lose control of the thing that we are selling. And in this instance, it's generally a building. We normally see sale and leasebacks over buildings. So in a sale and leaseback situation, we often haven't moved out. In fact, our staff don't know anything about this weird thing that's happening behind the scenes. And generally, the leaseback will include some sort of buyback clause. If we have those things happening, we often say we can't meet the criteria to have a sale because we haven't lost control. And therefore, we have what's called a failed sale, which means we can't de-recognize the asset. We can't recognize a gain or loss on sale. And the accounting looks really weird. Now, I'm absolutely not saying let accounting drive a business decision. If the right business decision for you is a sale and leaseback, then please go ahead and do that. Just be aware that the accounting and your financial statements may not look how you are expecting it to. So just make sure you've done some research into that if you are even vaguely considering any sale and leaseback. The next one is around supplier financing arrangements. And again, I think this has probably got more profile because of the current economic climate. So this is where we have an entity who, instead of paying their suppliers directly, they've set up an arrangement with a financier, and the financier pays the suppliers, and the entity who's incurred that liability pays back the financier. Now, often that is on later terms than the initial supplier invoice. All this standard does is require some disclosures. So if you have entered into any of these supplier financing arrangements, we do need to make sure that you are now disclosing those arrangements in the financial statements. So it doesn't change how you recognize it. It's purely some additional disclosures in that space. So I said I would talk about the first one and the last one in a little bit more detail. So let's work through and do that. The first one is an amendment to AASB 101, and it's around current versus non-current classification of liabilities. Now, I don't know very many paragraph numbers in the standards. I know the content of the standards, but I don't generally know the paragraph numbers. I do know paragraph 69D of AASB 101 because I'm asked so many questions on it. Now, those of you who may be familiar with this paragraph about what is a current, non-current liability might think, well, this kind of looks like it always has done, and why are we talking about this? And the definition is predominantly the same. All that's happened is the removal of one word from that paragraph D. It used to say does not have the unconditional right. Now, the International Board decided that unconditional didn't really mean anything. You breach a bank covenant, they're going to call on it. So let's remove the word unconditional because it's just adding words for the sake of it. And when that was put out by the International Board, that was fine. Nobody had an issue with that. However, what the board did is they made a few other amendments to the standard that they'd never actually put out for comment. So it took them about 3 goes to get this standard right. Those of you paying attention on that previous slide, you would have noticed there was lots of other standard names included in that. They were amending standards. So this standard kicked in for the first time at 31 December 24, 30 June 25 for the first time. And effectively what it does is it gives us much more explicit guidance around where we have any financing arrangement that includes any sort of covenant. Now, a lot of this isn't necessarily new from what we should have been doing in the past. The guidance is just more explicit than we've had. So let's work through this. So the first thing that we need to think about is, do we have any financing arrangements that have any sort of covenant that are attached to them? So it could be that your current ratio has to be greater than 1.2. It could be around the solvency or liquidity ratios. So we first understand whether those covenants exist. The second thing that we do is we then look at when are those covenants actually tested. So for example, scenario 1, I'm going to give you. The covenant is tested at the 30th of November every year because that's the anniversary date of the bank loan we've taken out. So if we look at the first question in this decision tree, is the entity required to comply with the covenant on or before the reporting date? No, because we'll assume we're a 30 June year end and our covenant is tested at the 30th of November. So what we do is we come down the right-hand side of that slide and we say the existence of that covenant is not relevant for our current non-current testing. So we can effectively ignore it. It's tested at a future date and we're making this assessment at the year end. What we will be required to do is put some extra disclosures in about the existence of that covenant. I'm going to cover what they are a little bit later on. Contrast that with scenario 2. Scenario 2, we are required to test that covenant at 30th of June at your year end date. So in which case, that first question, we would answer yes. So we come down the left-hand side of the slide. Did we meet the covenant at the reporting date? If we did, fantastic. We just do our normal current, non-current testing, or normal current, non-current presentation rather, not testing. If we didn't, not so great. Generally, we are going to be classifying that whole liability as current. Now that's pretty much that left-hand side, what we would have seen previously. The difference is that right-hand side that we can ignore future covenants and we will be required to do more disclosures. Now, I said generally, if you were to have breached a covenant at the year end, it would be classified as current. So let's have a look a bit more into that. The standard gives us way more guidance about what has happened if we have breached a covenant. Now, a few key things that can happen if you have breached a covenant. The bank can say, you've breached a covenant, calling on the debt, you need to repay us immediately. To be honest, it doesn't happen that often because if they call on the debt and you can't pay, they end up with the asset. They don't necessarily want your asset. So they'll generally work with you to try and come up with a scenario or solution where things get better. The way that they do that is they could offer you a period of grace. So what that says is we're going to give you some time to sort yourselves out and we'll ignore the fact you've breached the covenant for that period of grace. The third thing they can do is give you a waiver, which effectively says, let's pretend the covenant didn't exist. Now, if we're pretending the covenant didn't exist, that means that you didn't breach anything. So period of grace is where they still existed. There was still a breach, so just giving us time to sort it out. The waiver is where we pretend it did not exist. So consequently, if any of those things happen, we then need to go back to that paragraph 69D and say, do we have a right to defer settlement of that liability for at least 12 months? Now, the answer is my answer that I'm renowned for giving in many cases is it depends. It depends what the period of grace is. It depends whether it's 12 months or not. What's the waiver and what does that actually mean? The most important question for you is when did you receive that notification from the bank? We are at the 17th of June today. If any of you who are listening believe that you are sailing close to the wind on any of your covenants, but you haven't actually checked because you don't need to test them till 30th of June, calculate now. Don't leave the webinar, maybe after the webinar or tomorrow, but effectively you are looking to calculate it because if you think you're sailing close to the wind, and you do not test it till 30th of June, means you can't approach the bank until the 1st of July. You can't receive any waiver or period of grace until after the year end. Now, what that means in the standard is at 30 June, at your reporting date, you did not have a right to defer settlement because you've breached the bank covenant. If you have the discussions today or tomorrow, and we're finding some real success with this, to say to the bank, look, we obviously haven't tested yet, but we've applied the numbers as of today. We think potentially we might have a breach. We are seeing some great conversations where the bank says, okay, well, if that happens, we're going to give you that waiver. We'll give you the waiver today, so you've got it in place. So if you don't have the conversations pre-30 June, you can't get any waiver or period of grace pre-30 June, and therefore potentially your whole liability is going to be classified as current. Now, if you do that, potentially you are going to breach more covenants and your balance sheet certainly will not look overly pretty. So that's my first to do for you after this session. And when I said that there was a standard that required a moderate amount of work, this is it. So it's where you have a bank financing arrangement or any other financing arrangement, doesn't even need to be from a bank. If there's covenants attached to it, please make sure that you understand as soon as possible whether you potentially may breach those covenants at your reporting date. And if you do, have those discussions sooner rather than later. The next element that is much more explicit within this standard is around rollovers and expiry of facilities. Now, some of us may have been around when the Centro case was happening, and the Centro case was where the bank facilities of Centro were due to expire within 12 months of the reporting date. The directors were having a meeting about what we do about financing. At the same time, they signed the financial statements. However, that liability was classified as non-current for the financial statements, even though they did not have, at that time, an unconditional right to defer settlement. We've had much more guidance now in this standard to say if you do have a facility that expires within 12 months of the reporting date and you haven't renewed that facility, you haven't got that correspondence pre-year end, whole liability classified as current. But what we also have is this guidance that's shown on the slide. A slightly different font at the top is just a direct cut from the standard. So what it says is if the entity has the right at the end of the reporting period to roll over a facility for at least 12 months under an existing facility, it classifies it as non-current. So what we need to think about is what facilities have we got in place? Do they have a set expiry date, or are they a rolling or revolver facility? And what happens in order for that to roll over? Is it just an admin thing? Or is it where we actually have to submit new financial information? The financial institution has the ability to cut it. So we have to have a much better understanding of our facilities, the terms and conditions than we've ever had before. Those of you who are audited, it means that the auditors need to have a much better understanding of your facilities than probably they've ever had before. So be expecting lots more questions on this. Be expecting to be having to dig out your loan facilities and really understanding those terms and conditions. If we don't do this pre-year end, as I said, your balance sheet could be very messy because if you have to transfer all of that to current liabilities, it is not necessarily a great look for your balance sheet. And this is very much a bright line within the standards around information that you have in place at 30th of June. Now, if we want to think back to the decision tree that I talked about at the start of this. So all of this is really about that left-hand side. Now we're going to move back to the right-hand side of that decision tree, which in my example was where a covenant was tested at the 30th of November. And therefore we could ignore it for presentation purposes. But I said that there were some extra disclosures. So let's have a look at what those disclosures are. Effectively, what this says is if you have a covenant that you are ignoring for presentation purposes, you need to tell the users that it exists, because what it means is whilst we're classifying our liability as non-current today, come 30th of November, if we breach that covenant, it could be called upon, could all suddenly become payable within 12 months. So two elements of the disclosure. The first is that we have to describe the nature of the covenants and compliance with them. Now, because this is a new disclosure, we're seeing a real range of what is being disclosed in this space. We are seeing some entities who are pretty much just saying we have covenants. To me, that doesn't meet the requirements of the standard because it's not about the nature. We're seeing people who say we have covenants that deal with our liquidity and solvency. Arguably, that is around nature. We're seeing others that describe we have covenants, it's the current ratio, we have minimum amounts we have to comply with. And yet others who talk about we have the current ratio and we have to meet at least 1.2 at every reporting date. So I think we'll start to see a best practice, particularly after, certainly in Australia, we've had our June year end. But I would encourage you to think, make sure we're giving enough information for the user. Don't try and kind of be deliberately vague. That's not the controversial bit. The controversial bit is part B of this disclosure. So remember, this is a situation where we have a covenant that's tested at the 30th of November. What you have to tell me in your 30 June accounts is, have you identified any facts and circumstances that indicate that you may have difficulty complying with that November covenant? So that could include, for example, if we were to test that covenant at 30 June, and we don't have to because it's not tested until November, but if we did and we wouldn't meet it, that's a fact and circumstance that might indicate you may not meet the November covenant. So consequently, this is a new disclosure. It will involve some work to consider whether there are any facts and circumstances. Again, those of you who are audited, your auditors are going to be asking this question. This particular disclosure is in AASB 101. So it is one of the mandatory standards that is required to be complied with if you're doing special purpose accounts. And for example, in the ACNC, it's obviously required if we're doing general purpose financial statements, and it has also been incorporated into AASB 1060. So it is required for any tier 2 entities as well. So it's all very well that I give you the theory and I say this is what has to go in, but what I really wanted to do was to try and find a real life disclosure for you so you could see the type of thing that is being disclosed. It's quite hard to find because, as I say, it's a new disclosure and most of our year ends are June year ends. And I will caveat, there is a lot of words on this next slide. This is a disclosure that a listed entity put in their 31st of December 2024 financial statements. I'm not going to read them. It's there pretty much as a reference for you. I'm not saying that this is the best disclosure that's ever been written, but I think it's pretty substantial. And we would never have seen disclosures like this prior to the amendments up to that standard. So they actually get hit by a double whammy. In their first paragraph, they tell us that their loan facilities are due to expire within 12 months. So therefore, it's all classified as current. Then they tell us that during the year they have breached some of their covenants and they describe what those covenants are. Then they go on to tell us that possibly they're going to breach them again and again tell us what effectively their plan A, their plan B, their plan C is to try and get around continuous breaching and also what has actually happened since the year end. So, for example, a capital raising has occurred. So I just wanted to show you a real life example of some of the volume that we're seeing in this space and some of the detail that has been included in those disclosures. Now, at this point, I'm going to pause for a second to see if there is any questions, and it gives me a chance to have a sip of tea. So David, any questions or comments that might have come through so far?
No questions or comments yet, Carmen. So all good.
All right, let's keep moving through. Now, I said that this section was going to be about new standards. I am actually going to do a slight digression to going concern because I think it actually fits really well with that discussion on current, non-current liabilities. And I think that we will start to see lots of going concern issues that are happening at 30 June, given the current economic climate. So what I wanted to do first is to remind you of where the requirements of going concern are. And we're staying within that same standard, AASB 101. I've included a couple of the paragraphs that refer to going concern and highlighted some elements of it. Now, if I was presenting to a room full of auditors, I wouldn't just be presenting 2 paragraphs from a standard. What I'd be talking about is the fact that they have a whole auditing standard that deals with going concern. For the preparers, however, we don't have that. What we have is a couple of paragraphs in an accounting standard. So it very clearly tells us that management needs to make the assessment of whether an entity continues as a going concern. Often we think it's the auditors who have to make that assessment, but the auditor's role is really to assess management's assessment. So we have a standard that tells us very clearly that management has to do that. And if we have identified any material uncertainties, then we are required to disclose that. The going concern disclosure is often one of the hardest to do. It cannot be boilerplated because it is very, very specific to the entity. And it really requires an entity to give information about what's happened, what are they going to do about it, and what's plan B and plan C effectively around that. Sometimes we see some very vague going concern disclosures, but it's really about telling the users that we're okay, we're going to be fine. The next point in that paragraph 26 is around how long our going concern assessment needs to be. So our accounting standards tell us that it has to be at least 12 months from the end of the reporting period. Now, this is where we have a slight conflict for the auditors, because if I was talking about that auditing standard that exists, the auditing standard on going concern says that the auditors need to assess 12 months from the signing date of their auditor's report. So that can sometimes be quite different because your auditors aren't signing the audit report the day after the reporting date. It could be months afterwards. In some instances, it could be longer. So consequently, those of you from management, though from preparers who are listening, when you are doing your going concern assessments, just be aware of that. You're not going from 30 June to 30 June. You will need to absolutely expand that. And I'd be looking at somewhere around the probably 18-month mark to prove that we've got a going concern. So that's the standards. Then I wanted to jump and try and give you some practical guidance to help you. Now, you may remember from previous years, I am a huge fan of the UK FRC, the Financial Reporting Council in the UK. They're a government body and they put out some really fantastic resources. Their primary audience is UK listeds. We're not necessarily listeds, but the relevance of that is the UK listeds have to adopt the IFRS standards, which is what we have to adopt within Australia. So they've recently this year, a couple of months ago, have updated their going concern document. And I've just got a little picture of it at the top so you can go in and hunt for that. It is written for preparers. So consequently, it is a document that you can use and is quite a practical document. It's got lots of pictures. It's got lots of good disclosures, bad disclosures. I've just turned their going concern process into a bit of a diagram, a bit of a process. There are some slightly different rules in the UK. So it talks about things like a strategic report, which we don't have to do in Australia, but it's the same relevance for financial statements. So what effectively it's telling us to do is to identify everything, the risks and uncertainties that could affect going concern, and then we apply a funnel. And we filter out all of those that we don't think is going to be relevant. And then we start including some of those disclosures in the financial statements. A number of you might be looking at that and saying that's great, but we don't do a going concern assessment. We never have, never been asked for it. So then the UK FRC helpfully consider that do the directors or management always have to do a going concern assessment? We've just seen that the standards require management to make an assessment. So it has to happen every year. Now, the complexity of that assessment varies. It depends. If you are an entity that is going great guns, you've got positive operating cash flows, you've got profits every year, you've got amazing net current assets, you've got huge net assets, you've got great cash balance. Going concern assessment is probably pretty easy to do. Fairly simple thing. Could be that it's just a discussion at the directors meeting and it's minuted, and that's the assessment. If you're not in that situation, or you've got a huge number of borrowings, or you're sailing close to the wind on the covenants that we've talked about, or you've got negative operating cash flows, etc., maybe a little bit of a harder assessment to do, more detailed that is required. But effectively, we should have at every reporting period an assessment that is made by management and the directors about whether the going concern basis is appropriate. I think that the last comment on the slide is particularly relevant, and that's around biases. When we are doing these assessments, we all want to say that we are fine and we're going to continue as going concern and we don't know what the big deal is. We do have to make sure that we check ourselves on some of those biases, make sure that assumptions that we are using are reasonable, applying effectively our own professional skepticism rather than just assuming everything is going to be rosy. So how do we make these assessments? Again, I'm still linking into the UK FRC document. They provided this list of factors. Now, whilst I don't want to use the word checklist, kind of a good checklist that entities and their advisors and auditors can use. Now, many of you may be looking at this list and saying, well, there's about 50% of these that aren't relevant to me. Great, because that means that 50% of them are relevant to you. So consequently, when you are having discussions with the audit and finance committees, with the directors, with whoever it is, those charged with governance, start thinking about, do these actually have an impact? Do we need to do something different in respect of these? And have we documented how they could potentially affect our going concern? For the auditors who are listening, a great document for you to start having conversations with your clients around this. So that's going concern potentially linked to our current non-current liabilities, because if we are pushing more things into a current liability, potentially that unfortunately leads to going concern issues. I said that this section was about the new standards, so I am going to go back to the standard. The standard we're going to finish off with is AASB 2022-10. It is an amendment to AASB 13. Now, for anyone who is from a non-public sector entity, so a private sector entity, you may be thinking, I have absolutely no idea what this is. How have we got to the 17th of June and I know nothing about this standard? The reason being that it is not relevant to you. It is a standard that is only applicable to the not-for-profit public sector. And I know we have a few of those who are listening. In addition, within those entities, it is only applicable to any assets that you are holding that are not being held for cash generating purposes. So if, for example, we have a local council who has an investment property and that investment property is being rented out for market rent, not covered by the amendment to this standard because that asset is being held for cash generating purposes. Excuse me. This standard is applicable for 30 June 25, but interestingly is prospectively applied. Normally we're used to with our standards, we go back and we start adjusting things. We don't with this standard, it is only adjusted going forward. In addition, this standard is deemed to be a clarifying standard. So it is not necessarily an error if you didn't comply with some of the elements of this standard. And as you can see from that middle section of the slide, when the AASB issued this, they have made the comment that many public sector entities may actually not have any changes in relation to this because of those clarifications. So what I'm going to do is just talk briefly about the 4 key elements that are changed within this particular standard. The first one that I'm going to cover off on is highest and best use. So the way that AASB 13 works for everybody is that you look at the assets that you hold at fair value and you deem whether the current use is the highest and best use. And if it is, fantastic. If it isn't, you then go around and you consider all of the uses that are financially feasible, legally permissible, and physically possible. Now, what happens in the public sector is generally they should look at their assets and say, no, they are not held for the highest and best use. So we go around that circle and we look at those 3 elements and we generally fail on legally permissible. So we come back and we say, okay, well, it might not be at its highest and best use. There isn't any other use that would meet those 3 elements. So we're going to stick with the current use. The board decided that that seemed a bit ridiculous for all entities to be doing, regardless of whether they were doing it or not. So what they've done is they have limited the entities that have to do the highest and best use. As you can see from the slide, unless your asset is classified as held for sale, or it is highly probable that it will be used for a purpose different from its current one, you can ignore highest and best use. Practically, for many of you, probably makes no difference because you probably didn't do the highest or best use test anyway, but now you have a reason not to do it unless you meet either of those criteria. Financial feasibility, all this clarification does is give some guidance around what that means in the public sector, particularly for those assets that are not being held for cash generating purposes. Own use assumptions. So if we think about the public sector, and let's take something like roads or land under roads, nobody else wants to buy those. They're not toll roads. You're not going to make any money from them. You haven't got people rushing to say, can we buy your roads? Can we buy the earthworks? Can we buy the bridge? So consequently, AASB 13 requires us to consider what a market participant would do. In most cases in the public sector, market participants don't exist. So what this clarification does is says we get that market participants don't exist, and we get that you have to make up a hypothetical one, but there are some scenarios where you could work out what would you do because you are the market participant. So again, it's aimed to save some time to say rather than trying to work out what the pretend market participants would do, what would we do in certain circumstances? The third one, and probably the one that's going to require most effort for the not-for-profit public sector, is around the cost approach. So if we think about these assets, for the vast majority of them, you are valuing them using the cost approach, so replacement cost. What this standard does is give more clarification around what should be included in that replacement cost. So for example, if I stick on the road theme, if you were to replace the road, you are likely to do the work at night because people complain less about you doing roadworks at night than in the middle of the day in rush hour. Now, doing that work at night means you're going to incur more costs. You get overtime for the people who are working. You've probably got lights that you're shining so people can do the work, and there'll be some other costs associated with working at night versus during the day. What this standard says is if those costs would be reasonably incurred and you consider that it is part of the assumptions that would be used, you would include those. You also assume that the asset doesn't currently exist. So consequently, you would still include things like design and formation costs, etc. So lots more guidance, much more explicit guidance in the standard around how we apply the cost approach. I've spoken to a number of Auditor Generals in a number of jurisdictions, and none of them are expecting significant changes on adoption of this standard. What they are expecting, however, is that you will go through and you will have considered the standard and put together some sort of paper that says you've considered it. And either we don't have a change because of A, B, and C, or we do have a change because of A, B, and C. So just something to be aware of in that not-for-profit public sector space. David, I'm going to pause again to see if there's any other comments on any of those new standards.
None have come through, Carmen, but I think, yeah, like you said, that'll be of particular interest to some of those on the call today around local government assets, and particularly around some of the valuations that they receive that talk about highest and best use, and maybe this is the clarification needed to say, well, that's not necessarily the right way to value.
Yeah, and I think that's an important comment, David, that you made about valuation reports. So anybody who is getting a valuation report in that public sector space needs to make sure that the valuer is complying with 2022-10. It has been pulled into AASB 13, but I would explicitly state it in the instructions, because you don't want them to say we knew nothing about it and therefore we've ignored it for the valuation. And if you want us to consider it, there's another valuation and another cost.
Yep.
All right, so let's move away from the new standards, but I want to stay in that kind of standardy space. Often when we have lots of new standards, we can spend all of our time talking about the standards, and we don't get a chance to talk about some of the other things that exist in the techie world that I live in. We've got that opportunity this year because we don't have major standards that are coming through. So we've got these things called agenda decisions, and I just want to pull on some of them that might be useful for you. Before I do, I want to go back a step and I want to talk about what these agenda decisions are. So you can imagine there are numerous entities in numerous jurisdictions who are using the international accounting standards. And as people use them, what happens is people have questions, or people think they've found inconsistencies or things that aren't clear. So what they'll often do is go to an expert to get some help, and generally they're resolved, but sometimes they're not. So then what will happen is they will then go to their national standard setter. So in Australia, that would be the equivalent of the AASB. AASB might then look at it and say, probably is something here that's an issue. And they will often contact the International Interpretations Committee, which is a subcommittee of the International Accounting Standards Board. When they receive a question, what they do is they go out to lots of national standard setters and they say, is this an issue in your jurisdiction? Do you think there's inconsistent treatment? Do you think it's a broad scope or a narrow scope? And depending on what comes back, the International Interpretations Committee can do one of a couple of things. They can either flick it to the international board and say, your standard needs to be changed. You need to put this as a project. They can issue an interpretation. We haven't seen very many of those lately, but that would be a very narrow scoped clarification. And more commonly, what we see is an agenda decision. So this is where the committee looks at it and says, we've looked at the issue. We actually think it's covered by the standard because of A, B, and C. Now, whilst these are not standards, they form part of the hierarchy that we are required to consider when we are looking at the standards and the application of them. Consequently, it is important to be aware of their existence and ones that may be relevant. What we generally find is that preparers and auditors are aware of any that can be controversial, but not necessarily all of them. So you'll be pleased to know I'm not going to talk through all of them. I'm going to talk through the two that I have asterisked on the slide. I've listed all of the agenda decisions that have been issued in the past 12 months. There has been none issued since April. So if there are any that on a particular topic that interest you and I'm not talking about them, either shoot a question or a comment into the Q&A, or you'll be able to find them very easily if you just look at these names and type in agenda decisions next to them. So the first one I'm going to talk through is linking into the sustainability that we will talk about a little bit later on. Now, what happens is a fact pattern goes through to the committee, and then the question is raised. Now, this fact pattern is in relation to a manufacturing entity. Makes absolutely no difference. It makes no difference at all to the answer. So regardless of what entity you are, this could be relevant. And what this says is effectively this particular entity has declared that it wants to be greener. So they have publicly announced that they are going to make a commitment to reduce their carbon emissions. They're going to reduce the emissions over a period of time. And then at the end of that period of time, any emissions that they still have left, they are going to purchase carbon credits to offset those emissions. So effectively, they then want to be in a net zero position. The questions that were asked to the committee is we've gone out and we've made these statements. Do we have a constructive obligation? And if we do, does that mean we have a provision? They then asked a question about the other side of the entry, but it's the first two that are more interesting. So if we think about why we care if we've got a constructive obligation, because in order to have a provision, we need to have either a legal obligation or a constructive obligation. In this scenario, there is no legal requirement for them to reduce their emissions. It is something that they are choosing to do. A constructive obligation is defined as actions that an entity has created, or because of actions the entity has done, they have created an expectation in other parties that they will do something. So what the committee have said is you don't need to say who those other parties are. You don't need to say that it's Carmen and David who have these expectations. You can say that it is the community at large because of the public statements that you have made. The committee, unfortunately, didn't answer this question around whether there's a constructive obligation. They said very much it's facts and circumstances. It depends. So consequently, an entity will need to make the decision themselves about whether the work that they've done in making statements about where they've published that, who they've told, has created a constructive obligation. What the committee did tell us is that if there is no constructive obligation, there cannot be a provision because you failed that obligation aspect. If there is a constructive obligation, you then need to look through at the three tests that exist around whether we have a provision. So have we got the present obligation as a result of a past event? Have we got a probable outflow of resources? And can we make a reliable estimate? So what did they say about that? They said, well, let's assume we do have a constructive obligation. We're not telling you whether we think you do or you don't, but let's assume we do. During the time that we've made that statement, or at the time we made that statement, we don't have anything that's happened because what would we be providing for? Over the period of time that we are reducing our carbon emissions, again, haven't really got anything that we're providing for. When we get to the end of that period in 20x9, we have said that if we have any remaining emissions, we will purchase carbon credits to offset them. So if we have not purchased all of the carbon credits to offset all of our emissions, then yes, we do have that provision because that's an obligation that we are doing, and that is an outflow of resources. What this means to us is we need to think very carefully about statements that we are making and at what point are we creating a constructive obligation, and at what point are we then having to put through a provision. We are seeing a lot of statements around being green. Marketing departments, etc., are making lots of these statements, but what we're not seeing is that flow through to what does it mean in the financial statements. Now, as part of issuing this particular agenda decision, the committee gave us a great reminder, and they said, irrespective of whether you have a provision or not, think about what your commitment to reduce or offset greenhouse gases have said, and think about the impact of that on your other assets and liabilities. So, for example, if you've said that you're an entity that wants to become greener and you have plant and equipment that is churning out lots of gunk and it has a useful life of the next 8 years, is that realistic? Or if you really genuinely want to become greener, we're probably going to have to get rid of that machine within 2 years, which means that we are accelerating 8 years worth of depreciation into 2 years. Every time we think of inputs, assumptions, estimates, and judgments, we have to pull in this climate element think back a few years to the bad old days of COVID, and I said exactly the same thing during that time. We need to think about what assumptions we need to change because of COVID. We now need to think about what assumptions we might need to change because of any climate statements that we are making or any intentions that we are planning on doing, even if it's not been publicly announced, because we have to make sure that the value of our assets and our liabilities reflect the current situation that we have. So I think it's a really important agenda decision to get everybody thinking about what statements you are making. The next one I want to talk through is an area that is fairly new. This only came out in April 2025. And the reason that I wanted to cover this is because I think it is something that we all would much prefer to keep our head in the sand and ignore. However, because it has been released as an agenda decision, as I mentioned, it forms part of that hierarchy that we'll need to consider. So the question that was asked to the committee was around guarantees that were given. This particular one was in relation to a joint venture. So we have a joint venture and we are giving guarantees to them. For example, the joint venture wants to take out a bank loan. The only way the joint venture can get a bank loan is if they get a guarantee from the parent. We obviously have a fair number of guarantees in Australia, particularly because we have a class order that says that if you want to avoid doing financial statements, you have to have deed of trust guarantees in place. And what we generally see is we just completely ignore that. We may disclose the existence of it, but we don't do any accounting for it. This question that went in said, how do we account for these guarantees? So the question that was raised, or the answer that was given rather, was a bit of a decision tree. The first place that we need to go is into the financial instrument standard. Nobody ever really wants to go into the financial instrument standard, to be honest, but that's the first place we have to go. And what we do is we look and we see whether it meets the definition of a financial guarantee contract. Definition is included on the slide. If we say no, we then jump out of the financial instrument standard, SSB9, and we jump into the insurance contract standard. Now, if we don't want to be in financial instruments, we definitely do not want to be in the insurance contract standard, but potentially that's what we've got. If we don't have a financial guarantee contract, nor do we have an insurance contract, the standard tells us where you can't, or the agenda decision rather tells us that we can't give up there. We have to go back to financial instruments and we have to consider whether we've got a commitment, a loan commitment, which is defined, or whether we've got a derivative. Or do we have something in IFRS 15 or SSB 15 revenue? Are we being paid to give these particular guarantees? Or are we ending up in the provision standard? So we may well have a contingent liability, but has that contingent liability crystallized and have we got a provision? So what I'm expecting to see, what I'm hoping to see, I should say, that every time we have a guarantee that has been issued, we work through this process and we consider what have we actually got and do we need to account for it in the financial statements. We can no longer just ignore them and pretend that they do not exist. That's it on my accounting standards, agenda decisions, etc. So again, I will just pause for a second there to see if there's any questions that come through.
No questions yet, Carmen, but if anyone wants to ask any, I'd encourage you to pop it in the box and I'll ask you at your next break.
Fantastic. All right, let's move on to a regulatory update. So we're going to start with ASIC. ASIC last year, for the first time, issued what they called enduring focus areas. And traditionally, these focus areas come out very, very late in June. But what they did last year, because they issued these enduring ones, we assumed that that would mean that these were the ones that were just going to be issued every year. And that seems to be the case, or every 6 months. They have said that they will include information about any specific issues that they have for a reporting period. But these are the 4 that will just continue to be rolled out and keep existing. When they issued the media release, and it was issued in May of this year, they did comment that they were focusing on areas which involved a lot of judgment, including revenue. But revenue isn't on the focus areas. I am shocked that it is not, because I get so many queries and find so many issues in the revenue standard. But the focus areas that we have are those shown here. Now, we have talked about it previously. I am not going to go through them all in detail because you can read them as well as I can. I'm just going to pick on some of the points. When we talk about asset values, or when ASIC talk about asset values, what they're talking about is impairment. They're talking about whether you are holding your assets at too high a value. They're not talking about maybe you could revalue this up and maybe you could improve the asset base. They're very much talking about whether it should drop. And what they're talking about is two separate areas. So they've got financial assets, which is my bad debt provisions, my expected credit loss provisions. We need to look at the current economic climate and we need to think about the past, the present, and the future when we are looking at those expected credit loss provisions. Remember that our bad debts are not just based on overdue debts now. Expected credit losses require us to look at all receivables because those that are current may at some point become overdue. So we are looking at those. What we do know is that all those that are overdue were current at some point, and that's why the standard very much is written to say you can't wait till they come overdue. The other element of the asset values and impairment is around non-financial assets. So particularly goodwill. If any of you are holding significant goodwill balances and you are making losses, just reassess the assumptions that you are using in order to value or in order to continue carrying that goodwill figure. Because goodwill is the bit that was left over on a business combination. It's the touchy-feely bit, isn't really supportable by anything. So if we are still making losses and haven't had a write-off of our goodwill, please make sure that you spend some time looking at that. The other one that I am seeing quite a lot is deferred tax assets. We put them on to the books a couple of years ago because we thought we were going to start making profits. We haven't yet started making taxable profits. Therefore, is it still appropriate to recognise the deferred tax assets? It is something that is often ignored because it's kind of like, oh, yeah, it was the same as last year, it must be fine. But is it still fine? Is it still that we think we are going to be able to utilise that, or it's probable we are going to be able to utilise that in the foreseeable future? From a provisions perspective, we have talked about financial guarantees already. In relation to restructuring, we are seeing in the press a number of restructurings that are being announced. And remember, that is because if you want to recognise a restructuring provision for a particular reporting period, you either have to have started implementing the restructuring or you have to have communicated it to the relevant people. If you haven't done that, you cannot recognise a restructuring provision in the current year. We have stricter rules for those restructuring provisions than we do for anything else. Subsequent events, my message with subsequent events is, again, if I was presenting to a room full of auditors and I asked them what they do to identify subsequent events, they'd be able to give me in detail all of the work that they undergo and the subsequent event audit program that they have to follow. If I ask a room of preparers, what do you do to identify subsequent events? There's normally some uncomfortable shuffling and people won't make eye contact because you often don't have a process in place to identify what your subsequent events are going to be. You just kind of hope that you hear about them. Please make sure that you do have a process for identifying those events, whether it's regular check-ins with the chair of the board, whatever it is going to be, the CEO, because you do not want that call from the auditor a few hours prior to signing the accounts, and suddenly you discover that something has changed, which means your accounts have to change. The last column with a lot of words in is around disclosures. The general theme of that column is making sure that you are including very specific disclosures. We should be removing all of the boilerplate disclosures. The disclosure should be specific to the entity. Put yourselves in the shoes of the user and say, what would be useful to me if I was a user? Not just, well, I had it in there last year, so let's just keep it in there. And it may happen again in the future, so I better keep it in there. So that's our focus areas from ASIC. Regardless of whether you are governed by ASIC or not, it's really important to think about these because they are the only regulator that puts out these focus areas within Australia. So regardless of the type of entity, good thing to have the conversations with your finance committees, with your directors. I'm going to stay on the ASIC theme and I'm actually going to jump a little bit to sustainability. In relation to sustainability, ASIC have put out a regulatory guide, and I will talk about that when I talk about the sustainability section. And the reason I'm not talking about this in the sustainability section is because I think this is actually really important for all entities, regardless of whether you are governed by the new climate-related reporting rules. So in the regulatory guide, they have talked about the thresholds that are going to be in place for sustainability reporting. They have made it clear that the basis for calculating those thresholds is the same basis that would be used for financial reporting. So, for example, your large proprietary reporting. And it's the same basis: revenue, gross assets, and employees. What they've told us is more explicit than ever we've been told before from ASIC. So when we have questions around what revenue do we include, we now have explicit guidance that ASIC are telling us that yes, it's revenue in the revenue standard, as we would expect, but it is also any other revenue that you do in your ordinary course of activities. So, for example, if you are in the business of being an investment management company and your main revenue streams are dividends, then you would include the dividends in your revenue numbers. So, making sure that we're looking at the business models, and they've listed a few other standards there to consider. That probably was known. If you'd asked anyone for advice, they probably would have told you that. They should have told you that anyway. So, hopefully, that's not a surprise, but much more explicit. The one that I think is a little bit more interesting is in relation to employees. So we obviously have an employee threshold for large proprietary. We also have an employee threshold for sustainability. We're all generally comfortable, hopefully, that full-time employees, permanent employees are included. We're all, again, generally comfortable that we would FTE equivalent permanent part-times. The question that we're obviously often asked is, what about casuals? What do we do about those? In this regulatory guide, they have told us very much to look at the definition of employees and others providing similar services that are included in AASB 2, share-based payment standard. For many of you may never have issued a share-based payment standard, share-based payment, you therefore may never have opened, I'll get my words right, never have opened AASB 2. The definition of employees and those providing similar services I have included on the slide. Now, if we think about our casuals, I believe it's probably fairly hard not to say that your casuals are included within one of those bullet points. So the individuals are regarded as employees for legal or tax purposes may not be the case. The individuals work for the entity under the direction in the same way as somebody who would be deemed to be an employee, or the services rendered are similar to those rendered by employees. So what that potentially means is if you are in an industry that employs a lot of casuals, this is a point in time test. It's a 30th of June test or whatever your equivalent reporting date is. We cannot ignore those casuals. We've now got ASIC giving us explicit guidance around this. Just something to be aware of when you are looking at those tests. Moving away from ASIC, and I have a look at the ACNC. So for those of you who are working directly for not-for-profits or maybe involved in not-for-profits as part of any volunteer work, etc., that you might do, we haven't had anything coming out from the ACNC in relation to financial reporting explicitly. But what we have had is a quiz that they have issued. I mean, we all love a quiz. So consequently, we're not going to do the quiz now. I think it's useful to be aware of this because many charities have some really well-meaning people sitting on their boards or their audit and finance committees. They often weren't recruited because of their finance skills. And consequently, when we do come down to what is the knowledge of those on the board or the finance and audit committees for charity finances, it can often be quite low. This is a really interesting way to actually send it out, get your teams to complete this. To be anonymous, you don't need to know what their answers are, but it might actually generate some really good discussion and might mean that you are requested by some of the board members to actually give them a little bit more guidance or a little bit more training on this. You can see the topics that are covered. It is fairly broad and gives a really good understanding of what charities should know and what people involved in those governance positions should be aware of. Because as we know, charities and any other entity cannot rely on the finance person on that board to have that understanding. That's it for my regulatory update, unless we have any questions or comments on those.
None on those, Carmen, but we do have one just on that accounting standard 2022-10
Yep.
from a local government council. Question is, does that mean every valuation report should be reviewed / assessed by the council in accordance with this standard?
So I'm going to give you a technical answer and then a practical answer. So as at 30th of June 2025, we should be applying with 2022-10. However, practically, it is fully accepted that nobody is going to go back and do anything that was looked at from a valuation perspective last year. So there's a unwritten acceptance that as we go through and we do our rolling valuations, then we should be looking at this and making sure that the new valuation reports are in compliance with that. Having said that, there is that overarching requirement at the year end that says that all carrying amounts of assets should not be materially different from their fair value. So as part of this, we should be looking to say, are we aware of anything that could be materially different? So if I take an example, I said that we didn't expect material differences in adoption of this standard. I have a client who called me and said, we think we've got a material difference. And when we worked through it, what had happened is when they've gone through and said, we know we need to include A down to Z now because it's explicit, they looked back at their previous valuation and realized they hadn't included any of this. They ended up with a very material difference on adoption of this particular standard. So whilst I'm not saying we'll go back and review it all in detail and get new valuation reports, just have an awareness, which you should hopefully do anyway, about is there any of these major things that are now clarified that you didn't include? So for them, it was things like design costs, it was project management costs, it was those formation type costs. That's what they hadn't included previously. They'd very much included the costs of somebody replacing it and, the fluoro vests actually working on that asset.
Okay, thanks. I think that should answer that. Thank you.
That's all right. So let's move on. Sorry, was there another? No, all good. So let's have a look at some contemporary issues. Now, I made the comment earlier that nobody ever really wants to go into the financial instrument standard, and I'm now going to cover a topic that is something that I am not very familiar with at all, but I think it's important to be aware of, and that is in respect of tax. I said that hopefully there was something in here for everybody. This is for the really big end of town who are listening to this. We have a regime that is being implemented in Australia, have adopted the Pillar 2 tax reform. Now, effectively, the summary of this is to make the big, bad, evil multinational entities pay enough tax in the jurisdictions in which they operate. So there have been many jurisdictions worldwide who have adopted this Pillar 2 tax regime. It's not an Australian thing, it is a global thing, and jurisdictions get to opt into it. This particular regime means that certain entities will have to pay a minimum of 15% as a top-up tax. The entities you can see in that top bullet point of the slide is where they have global revenue that is in 2 of the previous 4 years greater than 750 million euros. Sorry, there should be a million in there. Apologies for that. This particular threshold is euros. We don't operate euros within Australia. However, what we have is a threshold because it's a global reform that we will have to keep translating effectively. Won't be an issue unless we have a huge change in the Australian euro exchange rate. When I translated, it's about 1.3 billion Australian dollars. So if you are a significant global entity, and hopefully you are aware if that is the case, this is something that you will need to look at. Why am I talking about it in a financial reporting update when clearly tax is not my space? Because the standard has been changed. So AASB 112, our accounting standard on taxes, has been updated. So what it says is Pillar 2 tax reform may well affect your income tax provisions. You only need to consider it from a current tax perspective, not a deferred tax perspective. And that is because this is actually really hard. So whilst I really don't know a lot about the scheme, what I do know is enough to say if you were operating as part of a global entity and let's say the top entity in your structure is within a jurisdiction that has not adopted Pillar 2, for example, the US, it doesn't say, okay, well, you can just ignore this, don't worry about it because your top entity is not affected. It actually drops down the levels and says, well, the next entity down, is that in a jurisdiction that's affected? And if not, then it continues down the levels. So consequently, if everybody above you is not in a relevant jurisdiction, it will all be pushed down to you. Even if they are affected, there's still going to be some push downs of tax provisions. The other challenge that we have is that the tax return, this will be reported in the tax return, but the tax returns are often completed way later than the financial statements. So if we don't know what the impact of this is from a tax provision perspective for the financial statements, it could mean that our financial statements are potentially materially misstated. So if you are affected by this, remember it is million euros, not 750 euros, then we need to make sure that we are speaking to our tax advisors sooner rather than later. If we look at what the standards require, this is just an extract of the disclosure. So you can see we are very much required to break out our income tax expense into our Pillar 2 and everything else. So you don't want to be thinking about this just as your financial statements are being finalized. You need to start having a discussion with your group entities if you are a global entity that has that global revenue exceeding 1.3 billion Australian. I'm going to move away from tax now into something we're all much happier with. The next part is for our New South Wales listeners. In New South Wales, you are about to launch into a portable long service leave scheme for the community services sector. Community services is defined within the Act. It's got a schedule within there which lists everything out. This affects for-profits and not-for-profits, and if an entity is affected or has employees that are affected, it is mandatory that they join the scheme. So if we look at who is affected, there's two elements for it. The first is that the work that I do as an individual is community service work. So let's say I was involved in drug and alcohol counselling within an entity that is not necessarily, that's not all they do. So I would be captured by the scheme. I would be required to be enrolled in that scheme. I'm eligible for it. The other element is I have an entity that does drug and alcohol counselling. Every person, that's all they do, their primary purpose. Every employee of that entity is able to join the scheme or is eligible to join that scheme. So even if I'm in the finance team and I don't ever go out and I don't do any counselling and I'm not involved in direct community service, because the entity's predominant purpose is to do community service, all employees are captured. Doesn't kick in until 1st of July 2025. So we'll see this coming through in the financial statements for 30 June 2026. There does seem to be some confusion about what happens to existing long service leave provisions. And there are some webinars that are on the New South Wales Long Service Leave website. I've read a lot of the correspondence and I still haven't found an answer to what happens with existing provisions. So I'm expecting we'll see some transition rules around this. Effectively, the scheme gives you 6.1 weeks after 7 years. However, if an employer joins the scheme and signs up the employees within the first 6 months, the employees get a bonus 12 months of service. Now, the reason we're raising it today is if you are an eligible organisation in New South Wales, if I was your employee and you didn't sign me up in the first 6 months of this scheme, I wouldn't be overly excited because you've just lost me a bonus 12 months. So consequently, just something to be aware of. If you are captured by this scheme, sign up sooner rather than later because it's actually a big benefit for your employees. The way that they are going to recoup the scheme is to charge a levy on the employers. So it will be a quarterly levy, I believe, that will come through, and that percentage will be determined each year. Next thing I just wanted to cover off is the tariffs that, again, hopefully they're all going to go away and we don't hear anything else about them. But unfortunately, I don't think that is the case. It is something that is happening that may well have financial reporting implications for you. It may well not. but we need to make sure that we have considered it. So if we are subject to the tariffs, and that could be because we supply to the US and we drop ship through China, suddenly we're captured by the tariffs, then it could well have some impact for our assets liabilities, including things like an onerous contract, because we thought we'd made all these sales and we'd had them locked in, but our prices have now gone through the roof because of the tariffs, and consequently there was no clause within our contract to pass on any higher taxes that were implemented. So we are still locked into providing those goods, but we're suddenly going to make a huge loss on them. It could be that we actually have customers over in the US who says, thanks very much, don't want the items anymore, they're too expensive. Therefore, we have huge inventory write-downs that we will need to think about. Again, as I talked about climate and thinking about your inputs, your estimates, your assumptions, your judgments, this is another area where we will need to consider this. The last comment that I've got there on the slide is think about other service activities. And I've included this because some of the reading that I've been doing. So consequently, if we are seeing sale of goods dropping, that means that the revenue is dropping. That means that there is less money to spend on marketing, R&D, etc., which means that there has been some restructurings in some of those service elements that we are looking at. It's also had a flow-on impact where any of those entities are outsourcing those activities to other agencies. So this can have a fairly significant impact. Just something to be aware of if you only operate in Australia. All good, not relevant to you, but just be aware of this if you are not in that space and doing any work with the US. The next one is our Consolidated Entity Disclosure Statement, or our SEDS. We spent a fair bit of time talking about this last year because it was brand new and it had been issued very, very late in the piece. So it was a very late addition to the Corporations Act. What this is a requirement for is all public entities. So that is not a listed, that is if you are a public company. If you are a not-for-profit and you are not registered under the ACNC and you are a company limited by guarantee under the Corporations Act, because you're not ACNC registered, you are also captured. So this requires us to go through and to include this SEDS in all public company financial statements that report under Chapter 2M. The challenging part is we have to list out all of our subsidiaries and we have to have the tax residency or the tax jurisdiction of each of those subsidiaries. I am continuing to hear that that residency determination is not necessarily easy. I am also hearing that some of the residencies that were disclosed last year aren't necessarily going to be the same residencies disclosed this year, as we've got more familiar with doing this, as we've done some more research, as this is less rushed. So just a caution that if you put a residency in last year and it was kind of not really sure, we're just going to put something in, make sure that we're reassessing it this year. The directors need to sign off that this statement is true and correct, which is obviously a very high benchmark, and this statement is required to be audited. So auditors need to get assurance, which means that we need support for that. I'm going to move away to a slightly different contemporary issue and a contemporary topic now, and it's around accounting standards and where we find them. So obviously I can't see the vast majority of you, so you could raise your hand and I can't see it. So I'm going to ask you to virtually raise your hands. As in, just put your hand up. I don't need to see what your answer is going to be. When you are looking at accounting standards or looking for accounting standards, how many of you, if I said to you, have a look in the accounting standard, would Google that accounting standard? Now, as I say, I can't see your hands and I'm not asking you to put your hands up. Thank you, David, who is very few of you have. Fantastic. Thank you for that bravery. I am going to tell you that Googling accounting standards, whilst it is absolutely the easiest way of finding them, is the thing that I'm telling you not to do. And the reason being is that we don't know what version of the accounting standards is going to come up. So I have had many a discussion with people where they have sworn black and blue that what I am telling them is not in the accounting standards. And then we've worked out that they're looking at a version that is 10 years old. And it is in my version because I'm looking at the latest one. So whilst it's easy, Googling probably isn't going to necessarily give you the right answer. Prior to a few months ago, what I would have said is go to the AASB website and have a look at their list of standards. They've got this beautiful long list, and that has all of the relevant standards that are in place and the latest ones. Now, the reason I'm talking about this now, and the reason I said prior to a couple of months ago, is because when I looked at this site and I was looking for a particular standard a couple of months ago, that standard wasn't on my list. I went back to the staff and asked them why not. And what I was told is that this list of standards is no longer being kept up to date. Now, if you go to this page, it doesn't look like this today because it was requested that could that list be removed if it's not being kept up to date, and it has now been removed. There is a comment that says this is not being kept up to date. So now where do we go? I've told you can't Google them. I've told you your list of standards aren't in place. The reason that that list is not being kept up to date is because the AASB has issued a portal or has launched a portal. So that's standards.aasb.gov.au is where we need to go to find all of our accounting standards now. So it has the most recent ones. It also has previous ones from previous reporting periods, and also has ones for future reporting periods that has been released. In addition, it is the only place on the AASB website that you will find the sustainability reporting standards, so that I will cover off a little bit later on. So when we are looking for our accounting standards, it is the portal that we need to be looking at. It is deemed to be, it is interactive. It's not deemed to be interactive. I'm still a PDF person. If I open the standard, I can find the PDF on the right. But otherwise, for those of you who are a bit more technologically savvy than me, you may love the fact that when you go into a standard, you click on this particular hyperlink and it will take you to the definition. Or if it references another standard, it will take you straight there. That's the way that the portal works. As I say, you can also still get the PDFs if you just prefer that like I do. Staying on a slightly different theme, I wanted to talk about accounting position papers. So we've talked about where you find your standards. What we're finding is that lots more entities are being requested to do position papers. That is because the independence rules for auditors continue to get stricter. Almost every year there are different changes, which means there is a lot less work that auditors can do to help you. They're not being awkward. They're not allowed to help because they have to very much have that difference between the work that you are doing and how they are auditing it. So consequently, we're seeing a lot more cases where people are being asked for position papers. And I've been getting a lot of questions to say we're being asked to do a position paper. I don't know what that means. Can you actually give us some guidance? So we thought it would be useful in this session to actually tell you what we mean when we are asking you for position papers. So firstly, why would we ask for them? We would ask for them where there is a choice in the standards, and that choice could be significant for you. We might ask where you've undertaken a new type of transaction that you have never done before, a complex transaction. In ye olden days, we used to have accounting policy manuals, and that would effectively set out how we accounted for everything. I don't have them anymore. I don't know why we don't have them anymore, but we don't. This is effectively what that is. So it is a record of why you are doing what you are doing. I get a lot of questions from people, and the question starts off with, I've just started a new job as a financial controller and a CFO, and I've come in and I don't understand how we're recognizing revenue. I don't understand ABC. I don't understand whatever it is, because there's been no record of how to do that. What we then do is create a paper that actually sets out. And more often than not, we find that it was done wrong in the past. But because there hasn't been that record of why it's been done that way, it's much harder to figure it out. So for your own purposes, thinking about these position papers, present them to the audit committees, make sure it's very clear. Now, there is no mandatory format. When we ask for a position paper, it's not mandatory that's got to include this, but we thought it would be helpful if we set out what we would expect to see if we are asking you to do a position paper on a particular topic. These headings are not mandatory, just gives you an indication. So what it comes down to is effectively you're telling the story. You're telling the story to the audit committee, you're telling the story to the auditors, and you're telling the story to your future self. If you're like me and you don't remember what you did yesterday, in 12 months' time, trying to remember why you did certain accounting is really helpful if you've got it documented. So setting out what your issue was, setting out the research that you did, setting out the analysis that you did, and any conclusion that you reached will actually really help to form part of your permanent finance papers. So hopefully that helps when you are asked to write a position paper. What does that actually mean and what do we look at? David, I've finished my next section. So while I have a drink of tea, I will throw to you to see if there's any questions or comments.
Yes, there has been a comment, and I think it relates to where we go to find the latest accounting standards. The comment is, it is so confusing now, which I think sums up what a lot of us are thinking. So I made a note. So we go to the website.
So if you just type
AASB?
in, and I know it's a little bit small, but hopefully you can read it. If you type in standards.aasb.gov.au, it will straight away open up that portal. So that's where we just need to go. Now, I don't know if the comment was the portal is confusing. I'm not disagreeing with you in that comment, or where it is hard to find where it is. But that link there at the top, that standards.aasb.gov.au, will take you straight to the portal. And that's what we should all be bookmarking.
Otherwise, we chat GPT it, I guess.
Well, if we chat GPT it, then we may not get the right answer as well. Yes.
Thanks.
That's a question I should have put up there. How many of you chat GPT it? Yes. Excellent. All right. So let's move on to sustainability. So I'm going to cover a couple of things, update you on some greenwashing things that we talked about last year, and then we're going to cover where we are in that climate reporting sustainability space. We've talked previously about greenwashing and how ASIC took 3 entities to court for greenwashing. Prior to that, they were issuing infringement notices, and we were ending up with fines of around $13,000, $39,000. It was fairly minor. 3 entities they took to court, being Mercer, Vanguard, and Active Super. Those of you in the superannuation space, in the local government space, may think that Active Super is familiar, and that's because they used to be called LGSS, Local Government Superannuation Scheme. They have recently, they're the most recent one, they have been awarded penalties, or given penalties, I guess, by the court of $10.5 million. That means of those 3 cases that ASIC took to court, $34.7 million were raised in fines. We aren't talking about $13,000 anymore. We are talking some fairly substantial numbers. Whilst ASIC very much are focusing on the investment space and investment management space, it is something to very much be aware of regardless of the industry you are in. And I thought it was quite useful to look at some of the things that came through in the court judgment. So Active Super, what they did is they said, we don't invest in any investments that pose too great a risk to the environment. And you can see the pretty pictures on the left-hand side of the slide of what we don't invest in. We then had a triangle that says, no way will we invest in anything that is a high ESG risk, and give those similar things. ASIC went in, and ASIC deemed that they were investing in these particular industries. And Active Super's defense was that any sophisticated investor would realize that they needed to look at the small print, and the small print did effectively say, look, we might invest in them if they're a good investment. The court's comment was no way means no way, and there is no way that any investor should have been expected to go and look at small print in relation to this. When they explored everywhere that these statements had been made, that is the bottom right-hand side of the slide. So you can see that there are some fairly substantial places that's been put. The website, understandable. Emails that have been sent out, product disclosure statements, an interview that the CEO has given in a magazine. My key message is please be very careful about any green statements that you are making. They need to be supportable. You do not want to be on my next slide around an entity that has been taken to court and these amounts that have been challenged, because we know that the government agencies, ASIC and others, are very much looking at this space. Greenwashing is a real thing, and we are seeing some huge, huge penalties that have been fined. So that's ASIC in the investment management space. If you're not in investment management, well, it's okay. Can we just ignore that? No, because we have the ACCC, who have also entered the greenwashing space. So the ACCC have looked at Clorox, who are the entity that makes Glad bags. You can see this particular bag that has been out in the market. it very clearly in big writing says 50% ocean plastic. It's made using 50% ocean plastic. Fantastic. What a great idea, because we all know the ocean is full of too much plastic. So what clearly they're doing is going out in the ocean, sweeping up the plastic from the ocean and making these bags. Amazing. I probably would have bought the bags if I'd seen them. However, the small print said, look, it's actually in the ocean, up to about 50 kilometres from the ocean, but it's probably heading there. So, it's close enough. The ACCC said, no, you say it's the ocean. We get that you've put small print. We don't care. It very clearly in big writing says from the ocean. The Clorox was fined $8.25 million as a penalty from the ACCC. Didn't even go through the court effectively. So what we are seeing is really big numbers around this. Again, come back to that point about please make sure that any green statements that you are making are supportable and you are able to provide evidence in relation to them. That's the scary bit about the greenwashing element. We're now going to get to possibly just as scary in that who will now have to report on our climate mandatory reporting regime. So what do we know so far in Australia in relation to this? The first two columns work together and then the second are separate. So we know that for-profit private sector companies have had a change to the Corporations Act. The Corporations Act that we'll see on the next slide requires a staggered adoption of climate-related reporting. The first entities, or first companies rather, will be required to go from 1st of January 2025. That is 31st of December 2025. So we are almost halfway through the first reporting season for the biggest group of companies. Other for-profit private sector entities and private sector not-for-profit entities, we have no idea. There is no draft legislation that's been put out. We don't know where the regulators are considering going in this space. Personally, I think everybody's waiting to find out what happens with the Corporations Act entities, see how much work, see how useful it's deemed to be, and then they might decide. Within the public sector, it varies very much depending on whether you are a state or local government and depending on the jurisdiction that you are in. For example, in New South Wales, the Department of Treasury has deemed that 27 of their agencies will be reporting climate information from 30 June 2025. That is in 13 days' time. It's not going to be audited in year one, and there's 2 universities that will go from 31st of December 2025. That will be expanded over the next few years. Those entities are going prior to the Corporations Act entities, which is really quite significant. We know that there are other jurisdictions who have mandated this for their departments and agencies. We have not seen any jurisdiction who has put out anything in draft for the local governments. We know it is being discussed, but we have not seen any draft consultation around this. My personal view for the local government entities who are listening is it would not surprise me if this is coming. But I can't give you anything around timing. I can't give you anything about any staggering, but it would not surprise me if this we start seeing this, particularly if all state entities are starting to adopt this. What do we have to adopt? We have 2 sustainability standards that have been issued by the AASB. They are the organisation within Australia who is issuing these standards. The standards have gone back to baseline, which means that they are pretty much identical to the international sustainability standards that have been issued globally. Initially, the AASB were kind of going along their own merry path. Luckily, they've come back to that global standard. What they have done is issued 2 standards, S1, which covers all general sustainability, which is a voluntary standard, and S2 is a mandatory standard if you are required to adopt that. We'll explore those a little bit later on. Where do you go if you want help? There is a lot of resources. I would start with the ISSB Knowledge Hub. That is the International Sustainability Standards Board Knowledge Hub. They have lots of webinars, and they interestingly have lots of webinars that link the sustainability reporting to financial reporting. So that's useful for everybody. ASIC have issued a regulatory guide, which also has some helpful information, and the AASB have just introduced a Knowledge Hub for S2. The professional bodies do have a lot of guidance out there as well. If you're to Google this, there is more resources and training courses than you can shake a stick at. What I would just say is just be careful about what the content of them is. Make sure that it is something that's going to be relevant for you, because this is a very broad topic and consequently no course can be all to everybody. So let's drill into these a little bit more. I said that the Corporations Act had been amended. That was amended on the 17th of September 2024 to be effective from the 1st of January 2025. These entities did not have a huge amount of time to get ready. It's split into Group 1, Group 2, Group 3 as we work along that picture from the left to the right. Group 1 entities are required to go first. From December 2025, they will be mandatorily required to report climate-related risks and opportunities information in accordance with AASB S2. The next group, Group 2, have an extra 18 months to get ready, and Group 3 have an additional 12 months for that. Group 3, their thresholds may look familiar to you. They are the thresholds for large proprietary companies within Australia. Australia as a country has gone quite early and has gone quite hard. Not many, if any, other jurisdictions in the world have gone down to that level in that Group 3 box. But this is where we are stood at the moment. There was no change in the federal election, so consequently this legislation is still in play. If you are one of the entities that is on that right-hand side, an NGAS entity, registered scheme, superannuation entities, and CCIVs, you do have slightly different rules, slightly different thresholds in relation to this. The other thing that was put into the legislation as part of that Group 3 being quite small was a materiality statement. Now, the materiality statement sounds great in theory. You can provide a statement that says we do not have any material-related climate risks or opportunities. Fantastic, we'll all just say that. However, that statement is included within the climate statement. The climate statement is audited. So that means if you want to make that statement, and David is your auditor, he turns up to audit, you just say to them, we don't have any climate related risks or opportunities at material. David's not going to say, no worries, okay, that's great, that made life easy for everybody, didn't it? Let's tick that off and away we go. In order for him to audit that comment that you do not have material related climate risks or opportunities, he's going to need supporting documentation. David also may well not have the knowledge to be able to assess all of that supporting documentation. So you might have had to use an expert to come up with it. He might also have to use an expert to come up with this. So whilst we do have the ability for a materiality statement in Group 3, it is not necessarily super quick and easy to be able to do that. So what we're going to do is going to have a look at the standards and some of the requirements of them. You will be pleased to know it will be a fairly high-level review. I'm not going to go through detail in the content, but I just want to give you an indication of the type of disclosures that are required. So first, let's look at S1. As I said, this is a voluntary standard. Now, if we think about S1 as kind of the umbrella standard, we've spent a bit of time today talking about AASB 101. That's our umbrella standard for our financial statements. This is the equivalent. So it covers all general sustainability things. It covers things like materiality. It covers fair presentation. It covers reporting entity. It covers connectiveness. So that's our fundamental standard. The problem is that because this was issued as voluntary and S2 was issued as mandatory, they had to take some of that real core information from S1 rather, and pop it in as an appendix to S2. So we do have S2 is expanded in Australia to bring in all of those extra bits that we needed. So we still have all of those concepts of materiality, fair presentation, etc. They're just included as an appendix in S2. If we look at the content of S2, what I've done is just lumped everything together in that 4 core pillars that are required by the standards. So we have governance, strategy, risk management, metrics, and targets. If you talk to people about climate-related risks and opportunities, they very much talk about greenhouse gas emissions. That's what we just need to do. We need to do carbon accounting and we need to work out our carbon emissions. Absolutely, you do. It is a requirement of the standard. And it requires us to consider Scope 1, Scope 2, Scope 3. Scope 1 is emissions that we are directly emitting ourselves. Scope 2 is purchased emissions, for example, electricity. Scope 3 is the emissions across our value chain. So that means, what are our customers doing? What are our suppliers doing? What are they generating? That's what's getting the attention. Yes, required, but as you can see from this slide, it is a teeny tiny portion of what is required to be disclosed. It is one bullet point in all of my bullet points I've got on the slide. There is a number of software providers who are doing carbon accounting. It's not that hard to do because there's a formula behind it. So that bit is not that challenging. The hardest bit is along your value chain. In my view, the first 3 pillars are the ones that are the hardest to do, because what this requires is changes within your organization. So if we look at things like governance, we're thinking about, have you changed the governance structure within your organization? Who is responsible for looking at climate-related risks or opportunities? Now, the answer might be none. And your disclosure might be none. We've done nothing in the governance space. Still complies with the standard. Doesn't look great, but would still comply. All of these behind the scene things around governance, strategy, and risk management are going to be the things that take the time to do, because that involves changes internally, that involves changes in monitoring, that involves changes in reporting, that involves changes to the risk register, involves potential changes to the strategy. You aren't doing your strategy every year. You might have a 5-year strategy. So consequently, do we need to change that timetable? Do we need to pull it forward, or are we comfortable with where it is for the time being? When we are thinking of business cases, have we thought about carbon? Have we thought about a carbon price? And if we haven't, why not? Why aren't we factoring that in the same as any other decisions? Why are we still focused just on the dollar amounts? If we have factored in the carbon price, how did we come up with that? How did we determine the carbon price that we were going to come up with? So you can see by some of these other disclosures, they are significant in the time that you are being required to implement these. We've just looked at the mandatory timeframes, and for many of you, maybe you're not covered at all. For some of you, you may be covered and started working on this. Others, you may be covered and you had absolutely no idea that you were covered by it. I would say start looking at baby steps around this, start implementing it. I think this will come for the vast majority of entities. So consequently, what can we do internally? Not necessarily to provide disclosures, but climate isn't going away. So consequently, can we make some changes to our internal systems around these? We've talked about this from a reporting perspective. This is also audited. So what this is the time frame under the auditing standard around how we audit this. So as you can see, we have an entity, and let's take our group 3s, because I think that's where most of you are going to be. We start reporting on this from 30 June 2028. In that first year, your auditor will be required to give limited assurance, which means nothing has come to our attention, on governance, strategy, and risks and opportunities, and Scope 1, Scope 2 emissions. You can see it doesn't take us very long to get to limited assurance on everything. And then we give reasonable assurance on everything. Reasonable assurance is there's no material misstatements. This is way more than we do in the financial reporting space. We don't report on the process that you use for do your management accounts and how you actually report that and how you do variance testing and the discussion at the board level. That's what needs to be discussed in here, and that's what also needs to be audited. So I just wanted to put that up just to show you that whilst you have the disclosure requirements, there's then obviously linkage into the auditing space for that. So that's where we sit from a sustainability at this point in time. Again, happy to answer any questions or listen to any comments on any of those.
No further questions have come through, Carmen.
Excellent. Thank you, David. I want to move on to some of the common queries that I get. Seem to expand my list, and I feel a little bit like ASIC every year in that my list is often very similar, but that's because I get the same queries every year. So I wanted to raise them and see these are the queries, and these are where I often see the errors. So you can start thinking about this. I have alluded a few times to revenue. For those not-for-profits who are listening, I'm still getting a huge amount of queries around which standard are we actually in. Are we in AASB 15 or are we in AASB 1058? And every time we get new agreements, we have to make sure we have considered that. For everybody else, for the for-profits and then not-for-profits who are in AASB 15, I still get a huge number of queries around how do we recognise revenue. And I sound like a broken record in that I keep going back and saying, you need to know what the performance obligations are. People are, we're not interested. We just want to know when we recognise revenue. You can't do that until you've got what the performance obligations actually are, because this standard focuses on promises. What are you promising to do for your client? And how do we transfer control of that performance obligation? So there is an assumption that you can just recognize revenue based on over time if you're doing the work over time. That is not necessarily the case. Recognizing revenue over time under AASB 15 is a privilege, it's not a right. Under the old standards, absolutely, you wanted to spread your revenue, just spread your revenue to your heart's content. This standard, we can't. So consequently, whenever I get a query with somebody says, okay, we're recognizing revenue over time, we're recognizing it over the period that we provide that service, my question is always, which part of the standard allows you to do that? I said I don't know very many paragraph numbers. I can tell you that paragraph 35 of AASB 15 is all about recognition over time. So in order to do that, we have to know which of those three elements in that paragraph we can use to recognise revenue over time. We don't have a huge number of new standards this year. If you do not currently have something that documents your revenue recognition methodology, and I'm not just talking about a boilerplate disclosure in the accounting policies of the financials, it's your opportunity to actually go through and make sure you have that written down. The next one is around control, particularly non-consolidation. So where we have entities who might have less than 50% shareholding and therefore we're not consolidating, even though we are the biggest shareholder and we effectively have the power, we may even have a casting vote in any major decisions. Issues around what does control mean versus significant influence. So significant influence, there is a presumption in the standard that if we have more than 20% of a shareholding of an entity, we have significant influence. Control, no such number. It's, do you meet the control definition? So do you have power? Do you have exposure to variable returns? And because of the power that you've got, can you affect those returns? So again, within your organization structure, make sure that you have reviewed the investments that you hold and you are accounting for them appropriately. Business combination should be really easy. We purchase a business, we work out the fair value of the assets. The difference is goodwill compared to consideration. But we are continuing to see reverse acquisitions, which is where little entity legally purchases big entity. And often that's not allowed under the accounting standards. We have to flip it and pretend that the big entity acquired the little entity. Or we are seeing a huge number of group restructures at the moment. And I wonder how much of that's the current economic climate. But there is a massive number of those group restructurings that are happening, which means we potentially have a business combination under common control. Share-based payments, again, I think it's part of the economic conditions at the moment in that we are seeing lots of modifications of share-based payments. We were going to give you a particular arrangement, and because our results haven't been great, we're not going to meet that. So we're going to modify that arrangement. We're going to extend that arrangement, and forgetting that every time we change a share-based payment agreement, we do have to change the accounting for that. Interest-free intercompany loans. Again, we're seeing more of these intercompany loans happening, and they're often interest-free. They're often at call, and if they are, not an issue. But where there's a term to them, so I'm giving you an interest-free loan for the next 3 years, the standard says, don't care that it's interest-free. You need to assign an interest rate to it in order to have the effective interest rate method being used. So if we do have any of those, be aware, we need to make sure that we are assigning an interest rate. Leases is just the gift that keeps on giving. Every time people think they've got the hang of the leasing standard, they realize that actually they've changed the lease and they don't know how to deal with this. So back when we adopted the leasing standard, we were all very good at looking at other contracts that we had that might meet the definition of a lease. those embedded leases, for example, a maintenance agreement over a specialised asset. Kind of not so great at that now. If we haven't got something with the word lease on it, we don't seem to be accounting for it. We do need to make sure that we are still including any contracts that include embedded leases and not just things that say lease on them. We also seem to have forgotten that we need to include make goods again. We all very good at it when the leasing standard came in, and we had lots of these make good provisions on our balance sheet, and they just seem to be dropping off again. So again, if you have a make good clause within the lease, probably 95% of them that I see do have that. We should have a provision. You might decide it's not material. You might decide that's why you're not booking it. Have you got that written somewhere? Not in financial statements, but in ye olde accounting policy manual or some document that tells me that you have considered it and you haven't included it. We are also seeing a huge number of changes to lease terms, and partly because depending on where you're located, you may still find that you are having a challenge getting people back to the office. Or it may be, depending on where you're located, that suddenly everybody is back in the office. So you didn't think that you were going to extend a lease and now you're going to, or you shrunk the lease, but now you have to re-expand it, or you need to shrink a lease. Every time there is a change to that, an assumption or whether it's an amendment, we need to make sure that we are accounting for that at the date that it became reasonably certain around that change, not just the date that it became effective. Convertible notes, I really wish they would just go away and we would stop doing them. But unfortunately, there's a lot of entities who are using this as a way of raising capital through an alternative method because the traditional methods of financing are not open to them. The key messages with convertible notes is that they are really, really hard. If you alter terms and conditions slightly, you will end up with a very different answer in many cases. It is the vast majority of cases that an entity will believe that their convertible note is 100% equity, and it is the vast majority of cases that the convertible note is not. There is a liability component to that. I'm also hearing about safe notes that are making their way to Australia. One of the challenges with the Safe Note is that if you look on the Safe Note website, it says very clearly that you should issue these instead of convertible notes because there is no debt element relating to them. I don't know who said that. I don't know why they said that. They clearly did not have an understanding of the accounting standards. All of the Safe Notes that we are seeing have a debt element to them. And certainly that is something that has been discussed around the technical arenas with the other firms in Australia. They are having similar challenges to this line on the website that we need to get rid of. So that's hopefully a bit of an insight into some of the things that I am seeing that are coming across my desk where we're seeing mistakes happening. I just wanted to finish off with a bit of a what's coming, and this is very much staying in the not-for-profit space because it's a topic that I continue to get lots of questions on. And that is around tier 3. So as you would be aware, we have 2 tiers of accounting standards in Australia. They both have the same recognition and measurement criteria, which means regardless of whether we adopt tier 1 or tier 2, the numbers are the same. Tier 3 will change that. Tier 3 is for certain not-for-profit entities. We got 2 exposure drafts issued last year. Comment period ended 28th of February this year. There has been 2 AASB meetings since that time. In March, they discussed very high-level preliminary feedback, didn't make any decisions. In May, they didn't really discuss anything either, other than agreeing with the timeline that the staff put forward, which said that the standard for Tier 3 should be released in the first half of 2026. So I thought it would be useful just as a reminder of what we are likely to see happening. There were 2 proposals that were put out. I would be shocked if this proposal didn't go through as issued. So what this is doing is removing the ability of certain not-for-profits to be able to prepare special purpose financial statements. At the moment, our not-for-profits have the ability to apply the reporting entity concept and therefore do special purpose if they argue that there are no users of the accounts that would be reliant on the general purpose. When this comes through, that will change. Those of you in the for-profit space who are looking at this and thinking, well, this looks familiar, very familiar, exactly the same as the for-profit space requirements. So what you are required to do is we start in the box that says start here. and we consider whether we are subject to any legislation that requires the preparation of financial statements in accordance with Australian accounting standards or accounting standards. If the answer to that is yes, you have to do general purpose accounts. There is no ifs, buts, but nobody looks at them. General purpose financial statements. It will be determined by the regulator what that means, whether it is tier 1, tier 2, tier 3, or whether it is a choice of one or more of those. If we answer no to that question, we then ask the question that do we have to comply with any document which require the preparation of financial statements in accordance with Australian accounting standards? That could be a grant agreement, it could be a trust deed, it could be constitution, bank agreement. If that document exists and does not require preparation of financial statements in accordance with Australian accounting standards, we can still do special purpose. If it does exist and requires that, there will then be a grandfathering clause in this particular standard around if it was created or amended prior to a certain date, and that date hasn't yet been determined because it'll be determined depending on the issue date of the standard, then you can still do special purpose. There will be additional disclosures. Otherwise, general purpose. So one of the reasons I'm raising this now is if you are in the not-for-profit space, you can't control the legislation, obviously, but you can control many of those documents. So if you are receiving grant agreements that require financial statements in accordance with Australian accounting standards, have a chat. Is that really what the fund provider wants? In most cases, no. All they want is an acquittal statement that shows cash in, cash out, and that you've spent it on what you should be. If you're setting up a new not-for-profit and you're doing a trust deed or you're doing a constitution, just make sure you haven't got these words in there, because going forward, you don't want to be locked into something that is not intended to happen. That, as I say, I'm fairly confident that will go through as is. I would be shocked if there are any changes to that. The next bit is a little bit more uncertain, and this is what will actually be included in the Tier 3 standard. So Tier 3 is meant to be a standalone standard. It will be one accounting standard that has everything in it for recognition, measurement, presentation, and disclosure. The intention was that it was made simple and it was made plain English. The exposure draft certainly isn't plain English, unfortunately. So I'm just going to talk through the first 3 points and then happy if there's any questions on any of the others. The first is that consolidation will be an option. So consequently, if a not-for-profit has subsidiaries, associates, or joint ventures, and they choose to consolidate or equity account, they can. But if they choose not to, that's okay too. That's an accounting policy choice. This standard has a lot of options. So from a comparability perspective, probably not the greatest that we'll have, because depending on which options an entity chooses, you will end up with very, very different numbers. Revenue, the bane of most not-for-profits. They are proposing to change the wording for revenue recognition, so it will be based on a common understanding of the parties. So I'm going to give you 2 examples. I'm going to give you some funding, and I tell you that it is to employ a counsellor for the next 2 years. So we have a common understanding that that money is to pay for their salary for the next 2 years. So consequently, you would recognise that revenue over the next 2 years. Or I give you some money and I say this is for operational purposes from 1st of July 2025 to 30th of June 2026. Great. We'll recognise the revenue next year. In those 2 scenarios, very simple, exactly what not-for-profits want, and makes sense. I am a little bit nervous that common understanding will end up a little bit like sufficiently specific, and the 2 examples I've given you make a lot of sense, but when we actually try to apply that and you're trying to prove to your auditors that there is a common understanding, what does that actually mean? So that's the current wording that was in the exposure draft. The AASB are obviously considering feedback on that, so we will see what happens in the final standard. The third point that I'm going to talk about is all leases are off balance sheet. So that means we will go back to recognising rental expenses and not recognising right of use assets and lease liabilities. What I should say is, whilst the regulators are determining who will apply this, the entities that the AASB had in mind when they wrote this standard was the middle tier of the ACNC. So revenue between 500,000 and 3 million. That's not to say that that's what will definitely come through. It will be up to the regulators to decide, but that's who they had in mind. Now, many of those entities may well have booked their leases on balance sheet. So as you can imagine, the transition rules within this particular standard are fairly complex because you don't necessarily have to completely unwind everything. It may be that, let's take leases, that you run those leases until their expiry, and then any future leases you are recognising off balance sheet. So this is a watch this space. The other one I'm fairly certain about. This, I think most of these will probably come through, but we're not actually certain until the AASB start having their discussions. That is it from me from a theory perspective. So I've left 5 minutes, David, if we do have any other questions or comments.
Thanks, Carmen. I'll just allow a little bit of time in case anyone's got a question about that last topic. We do have a lot of not-for-profits on the call, so they might be interested in your thoughts on that. You've usually got a reasonably good antenna with what the AASB is up to, so that's great to sort of get at that understanding. Okay, there's no questions coming through. So I might wrap it up and then I'll just have a quick look before we finish up. So no, thanks very much, Carmen, for that. That was sensational. Lots of different topics like you promised at the start. And as always, yeah, I've made a couple of pages worth of notes just to sort of go back and have a look at a few things that twigged in my brain as you were presenting them. So thanks again for that. And thank you for everybody for logging in and attending. I hope you found it useful. And if you do have any sort of questions, certainly contact your local Bentleys advisor. We have recorded the session and you will be getting an email in the next few days with a link to the webinar if you wanted to go back and just check anything that Carmen has been through. Still no questions by the looks, so I'll wrap it up and say, yeah, thanks again, Carmen, and thanks everyone for joining us. Stay safe and well and have a great rest of the day.